Hey, what's up, everybody? Welcome back to Investing Sucks. So, today we're going to be doing the next installment of the Your Company, My Analysis series, looking at a company called Spin Master, which is ticker symbol TOY.TO on the Toronto Stock Exchange. This is a children's toy company, and is it a company that I mentioned briefly in one of my past videos as something I might do a video on in the future, and a few people have been reaching out to me saying that they'd like to see a video on this company, so finally gotten around to it. And I think this is going to be an interesting one because this company does present some unique challenges, but also some unique opportunities when you're looking at it from an investing standpoint. So what I'm going to do in this video is I'm going to talk about the business, what they do, how they make money, and then also talk about what actually makes them unique, and then conclude the video by actually doing a DCF valuation of this business to determine if they are a good investment at their current price. And I was also interested in doing a video on this company because this is a company that kind of personifies the type of investment that I've been personally looking for lately, which is high return on capital businesses trading at relatively low valuations. So, what do I mean by high return on capital? Well, I mainly use return on invested capital, which is ROIC. So, if we look at what this has been in the past few years, we can see most recently this was measured at 126%, which is extremely high for a business. The year before that, it was 87%. And then even the year before that, 36%, which, I mean, anything over 30% to me strikes me as high. When you get into the 80 plus range, that is extremely high. So that's intriguing to me. And then also their valuation. So we can look at the price to earnings ratio to see what that has been historically to, kind of understand what they're trading at in terms of a relative valuation standpoint. And we can see that it's gone down a bit recently. So it currently sits at around 9.3, which any PE ratio under 10, I think most investors would agree that that's generally seen as quite cheap. And if we look at what their stock has done in the past year, it's pretty much gotten trimmed by about 25%. So clearly there is something negative going on in this business that people don't like. And what I also want to look at, just in terms of a quick overview financial standpoint, because this company sells physical products, this liquidity analysis section becomes very important, and you want to understand how fast they can move their inventory. And the way we can do that is you can look at this metric here, which is the average days outstanding for inventory, which is 60. And this is well below the industry average of 164. And if you're wondering where that industry average comes from, it's these companies here, which is in the consumer cyclical / leisure industry. These aren't all going to be toy companies. There's some toy companies like we can see Hasbro, Mattel, but then there's other companies that are kind of, in a similar space. For example, there's a golf company here, Yeti, which is a company I'm sure you guys have heard of before, which is I would honestly say it's pretty similar to Spin Master. But basically, they're selling their inventory faster than comparable companies. On average, it takes them about 60 days to receive payment once they've sold their inventory, which is the average receivables collection. And then on average, they usually take about 88 days to pay back their suppliers. So they have a cash conversion cycle there of 32. So it's usually about 32 days that capital is tied up for, because if you think about the cash conversion cycle logically, it's the average receivables plus inventory days outstanding, so 60 plus 60, 120, minus the payables, which is 88. So in total, you get about 32. So it's usually about 32 days that they have capital tied up for. The implications of that is when we do the DCF valuation. And if you're going to project this company to grow its revenues in the future, that means they're going to have to tie up some capital and purchasing inventory, which is a cash outflow. But we'll get more into that later. For now, I kind of just wanted to show this to you so you kind of understood what I was talking about and got a flavor for some of the unique challenges about this business. Okay, so let's next talk about what this company does and how they actually make money. So they have three main operating segments, which are toys, entertainment, and digital games. And they own many very popular IPs such as Paw Patrol, Bakugan, Hatchimals, Rubik's Cube, and many others that I'm sure you guys have heard of before. And the company was actually started about 30 years ago by two founders who still are involved in the company. They're on the leadership team and they still own the controlling share of the company as well. So you are dealing with a founder-led company here. So going through the three segments, you have toys, and this segment creates, designs, manufactures, licenses, and markets toy products such as stuffed animals, board games, and things like that. And this is actually the lowest margin business of the three. So here I'm looking at the Q3 management discussion analysis section, and we're looking at the segmented results. So this is the toy segment here, and we can see the operating margin here, just under 20% at 19.8%. So toys, obviously selling physical things, is the lowest margin of the three. The next one is entertainment, which is mainly just producing content and also licensing out their intellectual property to be sold through other means like clothing, live entertainment, etc. And if you look at this one's actually a much higher margin. We can see the entertainment section here, operating margin of 78%, but in terms of revenue, it's much, much smaller, only about a 20th the size of the toys segment, as they did $37 million in revenue Q3 2022. And then the last one is digital games. So this is mainly apps. So this would make money through subscription-based models and then also in-app purchases. And then if we look at the relative size of this one as well, again, this one is extremely small in comparison to toys at only about $35 million. And their operating margin is slightly higher than the toys one at about 24%. So the implications of this is you have this toys businesses, which is the lowest margin. It's not exactly low margin, but it is the lowest margin. But if you do start to notice increasing sales in some of these other segments, then what that means in terms of the margin is that it's going to increase in the future. So that's the main implication there. So what I like about this business so far is that it's one that I feel like I can understand, right? You don't really have to be an industry insider or have some specialty knowledge to understand what needs to happen for this business to ultimately be successful in future years. Now, there is going to be some complexity because the ways they make money, there's many different ways that they can make money, such as, the licensing, the product sales, the content, the app purchases, and all that type of stuff. But really what you can determine is that how this company is going to be successful is number one, it's going to be tied to just general demand for children's toys and overall economic conditions because it is a discretionary product, right? It's not a necessity. It's not something that people need to buy. So when economic times are bad, you're going to see things like this probably get hit harder than other companies out there. And then number two, you're also looking at the relative popularity of their intellectual property, right? Which is going to constantly be evolving, right? And just because one quarter they could come out with a movie that boosts results for that one quarter, the next quarter they could see revenue for their online games decline because there was a different online game that came out that just happened to be way more successful and that stole market share from them. I mean, there's just so many different things that could happen in this business. It's really, really difficult to predict with any type of certainty what's going to happen in future years. So this is a rather risky company, I would say. Now they do have this whole process on how their creative team, generates new ideas, they debate them, and then they decide which ones to implement. Some of those will be successful, most of them probably won't, but that is a big part of what you're investing in ultimately is their creative team and their ability to come out with new and engaging IPs in the future. They are also acquiring other IPs. They're not afraid to make acquisitions, and they've been doing that in the past few years. So I think that's one thing they're doing to just diversify the product portfolio and try and implement more what they call evergreen IPs, which is IPs that aren't necessarily going to have their ups and downs. But the reality is with toys, you're going to have those ups and downs regardless. I would even in a way compare this type of company to a biotech company. Maybe not quite as extreme as a biotech company, but if you think about a biotech company, they go through the phases of getting a new drug approved with the FDA. If it's ultimately proved and it becomes commercially successful, then you can deal with, windfall gains in that case. But it's very risky, right? So this is kind of a similar thing, but toned down a little bit because they can do very well with one product they come out with, but other ones can flop. And if they can't consistently get new ones to come out and do very well, then you're not going to see great returns on a business like this. And to give you an idea of what I actually mean by that, I want to pull up this tool, which this is Google Trends, by the way. This is for this type of company. This may seem weird, but this is actually going to be a really useful tool as part of your due diligence in this company. And what I'm looking at is Hatchimals. So Hatchimals was a very successful product for them about 3-4 years ago. And what this tells us in Google Trends is basically how trendy Hatchimals was being searched throughout the past about 5 years we're looking at here. And we can see, in this time, kind of in late 2018, so around the holiday season of 2018, that was when it was at its peak, right? It's being measured here, so 100 would be the highest. That was when Hatchimals was at its best, and you see this reflected in the company's financial results and in their revenue. But over time, it kind of died down, right? I mean, it kind of went up again here during the holidays, which makes sense. The next holiday season, it wasn't quite as high, and it's just gone down and down from there. So this is what you're dealing with this company. This kind of highlights it because you're dealing with relative changes in popularity and potential windfall gains, but most of the time the ideas aren't going to exactly work out. And if we look at what the implications were on their financials, so I'll go to their income statement here and look at the yearly view. So basically, this was in 2017, 2018. And so their revenue here was about 1.5 billion. Their revenue is basically stagnated from 2017 to 2020, which is interesting because throughout that whole time period, they were making some sizable acquisitions. So it was kind of, two forces moving in the opposite direction where Hatchimals wasn't as popular as it once was, and then new acquisitions were coming in, and of course, all the other IPs they have in their portfolio. So that is really the reality of this business. It is highly, highly speculative. Now, speculative doesn't necessarily mean bad investment. I think a lot of value investors misconstrue that, where if they hear the term speculative when describing an investment, they just immediately think bad. Speculative doesn't mean bad. Speculative just means the variance of your future potential returns is quite wide, right? It can be extremely good, it can be extremely bad. That's what makes it speculative. So the next thing I want to do is just quickly look at the financial statements for a bit, just to see what kind of things stick out when we look at it from a high level. So we already talked about the revenue and how it was kind of stagnating the past few years, but we can't help but notice in 2021, revenue went up significantly. And if we actually look at what the reasons why for that, which this is going back to their annual report, in this section here, they really just cite increased demand across all their product lines. So all their product lines did pretty well. They had much more sales in each of them. So it wasn't really because of one acquisition or one specific thing. They did have a Paw Patrol movie that came out, which was kind of a one-time boost to their entertainment section. But other than that, it was mainly just, better, stronger demand across their product lines. And then we can also look at their operating margin. So I'll switch to the quarterly view. And then if we look at the operating margin, we can see quite a lot of fluctuation. It was 30% in the most recent quarter here. They haven't come out with Q4 2022 results just yet, but it fluctuates quite a lot. We can see it was even negative in some quarters in 2019, some low single digits here. So that kind of underscores what we already knew about this company, which is it's going to be difficult to predict when we do the DCF model. And then if we look at the balance sheet, the one thing that you can take away from this balance sheet is they have a very low amount of debt. So a pretty high cash balance, about $675 million in cash and cash equivalents. And then looking at liabilities, total liabilities are actually less than their cash balance, which whenever you see that, that indicates a pretty strong balance sheet. So you don't really have to worry about solvency issues for a company like this. Okay, so next let's dive into the valuation for this company. I'm going to use the value a stock feature in my website here, which is called tickernomics.com, in case you're new to my channel and you're wondering what this website is. I'll leave a link in the description of this video if you want to check out this website and see what it's all about. But this feature basically helps us with the DCF valuation. It makes it a lot faster. The first step that we do is we just enter the ticker, and then when we do that, it's going to populate all this data here, which is where we're going to enter our assumptions. It initially populates it based off of the 5-year averages just to make things a bit quicker, but obviously we are going to change these. And it also tells us the cost of capital. So this company has a cost of capital, we can see calculated here, about 9.5%. All right, and I'll do a 5-year analysis for this company. Now, revenue growth, like I said, this company, it's going to be very difficult to predict what their future revenue growth is going to be. So what I personally do when I'm dealing with a company where there's a lot of future uncertainty is I try and work backwards in the valuation. And I'll try and put in numbers to see what the company needs to do, what they need to achieve in terms of financial results for them to actually be a good investment at their current price. And then once you have that determined, you can work backwards and think, okay, how reasonable do I think those future targets are for operating margin, revenue, etc. So to start, I'll put in, say, a 6% revenue growth. And the operating margin, we saw it fluctuated a lot. It was as high as 30 and as low as single digits. So I'll put something in the middle, just put 15% operating margin for the next 5 years. Tax rate, we can just leave at 23%. Their capital expenditures and depreciation, I'm just going to leave these based on the 5-year averages because these are both pretty minimal and they don't really impact the valuation that much. Now, in terms of working capital investments, I talked before about how they have that 32-day cash conversion cycle. That does mean that they are going to have to invest in their working capital. If we're also assuming they're going to grow revenue at 6% a year, they need to invest in things like inventory to actually achieve that, right? So, in order for a valuation to just make logical sense, I'm going to up that a bit and I'll put $25 million in working capital investments each year. The share dilution slash buyback rate, I'm just going to change that to 0. And then I'll leave terminal cash and their debt balance the same as what it is currently. So then I hit this button here, calculate DCF, and we can see with those assumptions, they are actually undervalued. We get an intrinsic value of 36 US dollars, by the way. So all the figures that you see here, including the stock price, are going to be converted into USD. Even though the stock price itself is in Canadian dollars, our website converts into USD. So their current stock price in USD is about 27. So they are slightly undervalued at this. They're not quite as undervalued as I'd like them to see in order to get comfortable, but we are assuming they're undervalued under these assumptions that we've entered. So what we can do next is open up the details tab and we can see what we're actually projecting in terms of financial results. So we're basically saying that revenue by the year 2028 is going to hit about $3 billion. Now, looking at it was historically for this company, we saw that it kind of stagnated a bit, right? If we go back to the financials and we look at the annual revenue here, we can see, that does, personally, it strikes me as optimistic. Now, they have seen some growth in the past. And what's nice to see is that they've been doing all this growth, but they haven't actually been increasing their shares outstanding that much. We can see it's been pretty much constant for the past, 6, 7 years at about 103 shares outstanding. So even though they are making acquisitions, they're not issuing a ton of shares in order to make those acquisitions, which is a good sign because that's basically the same thing as organic growth, right? Even though it's not organic growth in the traditional sense, if they're using their internally generated cash to buy businesses that lead to more sales, I mean, to me, that's basically the same thing as organic growth. But for this company, we can see 2028, in order to hit just under $3 billion in revenue, for this business to be considered, attractive at its current prices, to me, that does strike me as high. And the reason it strikes me as high is if we look at this press release that recently came out about their Q4 results, we can see that it wasn't a great quarter for them. And the main reason they cited for that was mainly just because of macroeconomic conditions, which makes sense, right? Because toys are a non-necessity. They're one of the first things that when you see a drop in demand and a drop in consumer sentiment, toys are going to be one of the first things that customers stop buying because they're a non-necessity. And they did also cite one of the reasons why was just due to timing of the orders, where they said they had more orders placed earlier in the year. And remember, when we say orders, we're referring to actual retailers, right? Their customers are retailers. Their customers is not the end customer. And retailers will often order products in advance, right? And they were concerned about supply chain issues, so they ordered more in advance in the year 2022 than they have in the past. So that is actually a legitimate excuse. And if we look at what their revenue was overall, it was pretty much flat. We can see in 2021 it was just over $2 billion, and then 2022 just over $2 billion. It did decrease slightly, about 1.1%. And if we look at their Q3 earnings call, one thing that they mentioned was that they don't expect 2023 to be a great year for similar reasons, just poor macroeconomic conditions, high inflation, higher interest rates, also the inflation that you're seeing in food and housing prices that they're talking about here. Now, we'll see if they reiterate a similar sentiment in their Q4 earnings call, which happens in early March. It will be interesting to see that. But that's kind of the main takeaway that I got and why I don't really have a whole lot of confidence that they'll be able to meet these targets because growth was flat, from 21 to 22. They're saying 23 isn't exactly going to be a great year either. This growth is going to have to come from somewhere, right? And ultimately, what we talked about before is that for them to hit those targets, they're going to have to keep introducing new products that can help offset the natural decline of some of their older products as those kind of phase out and they're less popular, right? and they're going to have to introduce new products that are successful enough to grow the business overall. So not just replace the lost sales, but also add to sales overall. Or they could also just see their existing businesses perform well, like they could see, more in-app purchases, more toy sales, whatever the case may be. There's plenty of different things that could happen. But ultimately, just from what I learned about this company, hitting these targets does seem like a bit of a stretch. And we also have to assume that, they're going to stay at about 15% operating margin throughout that whole time period, which again, they were way above that in some quarters, but then below it in some years. So there is a lot of uncertainty. Personally, I would set a price target for this company probably in the $20 range. And I don't mean 20 USD, I mean $20 in terms of Canadian dollars. So that would be, they'd have to fall quite a bit more from where they're at currently. But, that's just my opinion. And I think currently the company is fairly valued for what it is, right? There's obviously a ton of risk. And what we learned from this is that there is a little bit of growth currently priced in to the valuation. So analysts and investors have at least a little bit of confidence that this company is going to, at least come up with something and they're not going to decline in the future. Because that is a possibility as well. Just as easily as this company could grow, they could also, not come out with any new products that really catch on with customers and they could decline. One thing we can do here is enter 0% revenue growth and see how that changes the valuation. They're still actually slightly undervalued. So I guess, the company right now, we could change this to say a 12% operating margin just to make it a little bit more pessimistic. So now they're overvalued with those assumptions. So it does seem that there is at least a little bit of optimism priced into this company right now. But if you own this company, comment the reasons below why you own it, what you see in this business. For me, this is probably going to be a pass, but I hope you did find this video useful and you learned something. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you'd consider subscribing. And I'll see you guys in the next video.